So my prediction is I'm going to be 33% better than I was yesterday. Okay, so in my haste yesterday, I realized that there was something that I wanted to point out about the reasonable expectations grid that I shared with you guys. For those who weren't around yesterday, I was doing a piece on comparing yourself to peers in the industry, being sure to know your margin to equity and risk parameters, and obviously make equations if you're going to look at the asset management end of the business, because as opposed to prop, they tend to be dialed back, so the numbers are different. And if you get proficient at it, you'll have a pretty good idea of where your performance fits in your strategy. But what I didn't articulate the way that I wanted to is, if you look at the share, I've got the grid back up again. I wanted to make sure that you guys are clear that, remember, I don't know who these guys are. I just picked this out of random because they had more than 10 years of history. They didn't have $1 bazillion under management, and they were very high on the annual return ranking amongst the 600 or 700 reporting CTAs. And this particular firm is running a multi-market, multi-strategy, long-short program, which is very typical to create grids like this. But what you need to be aware of is that if you're an intraday trader, an intraday swinger, as we would call it, trading swing to swing intraday, you have to account for your series. So what you're more likely to see is, while these guys, let's just say for discussion purposes, maybe they have a dozen trades, positions maybe in an entire month. So just like for your program intraday, it isn't remarkable for them to hit a series to have, 6, 8, 10 losses or whatever, nothing works out, and they kind of alternate average winning month, bigger than average losing month, grind out an edge over time, and that's it. Every trading program is like that. But if you're trading intraday in a single market, where you see the red versus the black in this grid instead of monthly, you might have a series where you had a majority of months that were winners, but your negative in your series would be, where you look at these as monthlies, this might be what your week looks like or what your day looks like. So, you get the best of it this week, next week you don't. The week after that, you get the worst of it again. Week after that, you have a really good week, and so on and so forth. So I'm not suggesting necessarily for a single market intraday strategy that your month-to-month grid necessarily would look like this if you were performing well. So I really wanted to make that clear. But make no mistake, the black and red alternating and down being as common as up is shared amongst all trading programs, whether they be proprietary or run via an asset management operation. And if you are having the unreasonable expectations of requiring that if you're not always winning, quote unquote, that it means that there is some inherent error in your analysis or your methodology, I'm wanting you to be clear that you don't want to be too quick to jump to that conclusion, because it leads to method hunting, and you just keep bouncing from one thing to the other, trying to find the thing that wins all the time. It doesn't exist. Trust me. So that's what to take out of this grid. Okay. I've just changed the slide to a obviously a zoomed out view of the current market structure, as we call it. This is usually the presentation that we will do in the boot camps, because we get it. Everybody likes charts, and they want to figure out ways to enter the market, and the general methodology for analyzing price behavior and finding entries and exits. So this begins that segment, because we happen to have 2 slots this week. On the DTG forum, our little dojo, as we call it, we have one of the boards is something called the methodology white paper. The methodology white paper, because most of the people over the years and our sort of the accidental evolution of even creation of what became DTG, we would interact with a lot of short-term intraday traders, specifically futures traders that were trading the S&P intraday. And the methodology white paper basically evolved as a highly adaptable approach. And when I say adaptable, I mean that there are literally thousands of little divisions of, what components of the triple component nature of the methodology to apply to whatever, in different ways. I mean, we've got guys trading different markets. We've got guys trading different periodicities. We've got guys using varying degrees of discretion, biasing, correlation with other markets against the cash market, premium, spreading, so on and so forth. So before you get too zeroed in on this is like, step by step, 1, 2, 3, you just do this. If you know us, you know that we don't believe in that. It's a dynamic environment. You got to find what resonates with you, and you have to adapt it on an ongoing basis. So this is like the shell that people take to develop their models, figure out what risk models appropriately apply to their chosen strategy variants. But this is sort of the anchor of typically what the guys in our crew are doing variants of. Okay, so like I said, there's basically three basic tenets of the methodology, which is a top-down approach. The trifecta, the trinity, whatever you want to call it, and those three components are market structure, price action, and order flow. The basic beginning of it at the top-down approach, market structure, is basically identifying key areas in the market that are going to attract participants on both sides. It's very important that you understand it's not predictive in any way. We don't use it, although we do lean on market profile, we don't use it in a classical sense to predict whether the market is likely to rally or retrace or whatever. It's sort of beyond this discussion to get into the depth of the ways that we use market profile. But suffice it to say that whatever profile is being built on today's chart, in our view, is a function of what has happened in the past. And what has happened in the past is driven currently by the vast majority of participants who all they have to go on is the past. So we're very, very concerned with major swings in the market. Well, geez, Rob, what time frame do you use? What kind of chart do I put up with this? With us, we're trying to remove time from the equation. So what we want to identify is the major structures or swings, if you want to call them, in the market that kind of form zones around key areas where we'd expect participation that everybody in the market in any relevant periodicity and strategy is likely to be clued in on, okay? So what that means is when we take this zoomed out approach, when we look at market structure, we're seeing what we want to see, what everybody can see. So guys that are using 120-minute charts, 60s, 30s, not even time-based charts, point and figure people, volume-based charts, tick chart guys, even guys that are going way down into 5 minutes, 3 minutes, whatever. If you scrunch them up, you're going to see these same major swings are going to show up no matter what the participant's looking at for a chart. Chances are that participant, if he's an active trader or even if he's not an active trader, is doing what you do, what I do, what everybody does. We try to be aware of what the structures are in the market, and we use them to make decisions. Regardless of what the minutia is of how you choose to enter the market, you go, well, 99.50 is the high. That's the key high. So I'm going to decide what I'm going to do there, or I've already decided what I'm going to do there. No matter who you are, or maybe you were already short from below, and you've got to stop, and you say, I'm calling uncle and throwing in the towel if if the market auctions above that level. So us knowing that's what drives a lot of participants in terms of how they define their entries and their exits, whether losses or wins, i.e. stops and things like that. We want to be very aware of what these structures are. You guys have seen our sheets by now in the Bootcamp page that we put up in these boot camps, and you've seen that we do a plan sheet that gets published every day. It's actually NJ's personal plan sheet, where we take and form zones around these key structures. Now, how does the DTG methodology white paper basically use these? How do most people use them? They use them in a way that involves a non-predictive approach of saying if and when the market reaches this structure. Non-predictive. I don't know whether the market's going to go up. Remember from yesterday, just as review, it's a living, breathing organism. You can look at anything that you want. You look at any chart you want. You look at order flow. You read the book. I don't care what you do. You don't know what's going to happen next. None of us do. We can't know. It's impossible to know because it's a constantly evolving environment. It's like being, my broken record analogy, being a card counter, and you see that the 6-deck shoe gets shuffled, and then you watch the cards come out and you keep a count. That count is invalidated if the deck gets, or the shoe rather, gets reshuffled. That's what's happening in the market constantly. The shoe is constantly being reshuffled. So the count, whatever the count was 5 minutes ago, is immediately invalidated. That's not my opinion, that's a fact. It's often a self-fulfilling prophecy, and it looks like certain things can be very predictive in terms of what happens in the market, but it really doesn't. That is determined by the aggregate decision-making of the participants, which is unknown in the future. So with that, these structures are used in a non-predictive sense, where if we trade, for example, somebody might say, and I'm not saying necessarily that this would be your particular strategy, you might have biasing reasons, other reasons for having a tremendous bull bias today. You might say to yourself, I would like to short the 99s if we get up there and I see what I want to see in price action and order flow. Okay, so that's sort of the first component in the top-down approach of knowing what the structure is, identifying where it's very likely that longs and shorts are going to fight, and then using other tools to decide according to your specific strategy how you're going to capitalize either on that fight or on the ultimate outcome of that fight according to the range. Now, you don't know whether, again, and that outcome, like I said, is going to depend whether you're a winner or a loser in that outcome on what your risk overlay is. If you're a tick scalper, you might have a very high win rate, but when you get dinged, you get dinged. If you're a longer-term swing-to-swing trader, as we call it, you might have win rates in the even money range, so 40, 50, 60% at absolute most. You try to keep your risk model aligned so your wins are bigger than your losses on average over groups of trades, not individual trades, because you don't know, any individual trade can come out any way. We don't know. And then you grind it out, groups of trades, just like what I was trying to show you in the grid yesterday, okay? So that's the concept of market structure. And what I'm trying to show you on the share here is that it isn't a mystery. Notice, I'm drawing these lines from before. Why did the market build volume today? You see the little volume spike on the profile. Why did it occur right at 99.5? Well, because everybody in the world is looking back at the major market structure in their own way with different time frame charts, with their own analysis, and they're competing at that level because it's important. And if you draw lines from the red boxes on the left all the way over to the right sequentially as it happened, you'll see that almost every swing in the market, this happens to be a 60-minute chart, I think, but you're going to see the same thing on 120s, the same thing on 30s, the same thing on 15s, the major areas that are respected in the market. You could basically, within a few ticks, obviously, because when they reach those areas, they either early reject or they spill a little bit because there's flow in place. There's, passive orders and so on and so forth, which we're going to get into when we talk about the order flow next. But suffice it to say that, this happens in every market and predictably so, because all any traders have to go on is the past. They're all using the past in some way to make decisions of how they're going to act and hopefully be successful in the future. Okay. So, I know it probably looks like gibberish, but that's it. So the typical DTG trader will will use this in a similar way. You know, if and when the market gets to this area, I like that. I think it's a major, you know, former resistance turned support, which is what the 95 area is now. You know, I still think the bull's alive, yada, yada. If it gets back here, I'm going to look for it to firm up. And if it does, I'm going to get long, and then I'm going to trade back into the 99s or whatever. And then that'll be my first scale point. And then I'll try to scale, you know, above that, wherever the next structure is above that. Now, as I'll show you today, we have an interesting situation where we broke to new highs. So normally, you know, some people stand aside when there's no prior structure to lean on. And others don't, and they use other criteria to determine spots to look for where they expect action. But normally, you know, you would have a very defined high in the market and low in the market, obviously, which is zero. And there's always going to be some next structure above or below to trade to. So typically, the members will sort of align their scale point to say, okay, if I get long here, my first scale is going to be around the 99s, unless I see the bull really strong and there's no reason for me to scale, so I'll hold, and then, you know, or maybe they scale, and then the next one is the 3s above that and the 5s or whatever the major structures are. So that's basically how they're using it. Non-prediction. If and when it gets here, I'm going to go to my next component of analysis, okay? So that brings us to price action and order flow. First off, just sort of by way of introduction, people will ask, this is Investor RT running the AMS tools. AMS is a developer in the Netherlands. They are a friend of ours. And a guy named Niels, who you've seen around the forum, or here's that 3 hours of sleep coming in. Have you seen around the room here, Danny's room, as the creator of the AMS Delta print? You guys have seen this stuff before. It's all over. Every software program at this point is chopping up bid and ask volume and displaying it. What is convenient about this is Niels is doing it in interesting ways. We don't really have time to talk about it, but suffice it to say that it runs on top of Investor RT. It's actually using the same data engine that was created by us, Investor RT, that was the engine that powered Market Delta when Market Delta was with IRT. Market Delta has moved on, and now AMS is your vehicle if you want to have that all-in-one access to the tools. You also see, you know, that are available in IRT. You'll see that the there are pinkish zones that are on here. Rewind to what I just discussed with market structure. Each day prior to the market, NJ does his sheet and identifies his key structures and sort of forms a zone around them, right? Because, you know, no one swing price is going to be respected to the tick, obviously, because, you know, there's flow driving it that's going to make it early reject or spill a little bit beyond it. So it draws a likely zone where he expects the action to occur. And we have it set up for our members where it's a quant that basically auto-populates our levels into the chart for our members automatically, so that they have a way, and some of them create their own levels as well, who have different opinions about what the key structures are that they're interested in. So that's what those zones are on the chart. Just for nomenclature purposes, for anybody who doesn't know, when you see these bars that are on this chart, they are basically just making a really wide candlestick. And what you are seeing on the right-hand side is all the trades that occurred at the offer, and on the left-hand side, all the trades that occurred at the bid. Obviously, you know, that data is readily available through all the feeds. And then it's just forming that into a giant history of the tape, is what I call it. If you're a tape reader, if you're old, like some of us, and this stuff didn't exist years ago, and you wanted to know what the density was, or who was trading where, or whatever, you either use the tape directly, discretionally, or you had other arcane tools to help you memorize what had occurred on the tape, trades at the bid and trades at the offer. Nowadays, we have these great tools where we don't have to have good memories anymore, like everything else technologically in our society. It's dumbed down to a level where it keeps a nice running record for us, so it's really great, and it can be used in wonderful ways. I mean, it's amazing what's available these days, and this AMS tool is fantastic. I'm going to scroll this down a little bit so you can see. You see the data boxes here in the bottom. Basically, those are statistics for segments of size in the market. So in this case, for the S&P, we have the broad market is on the top, meaning all the trades. And then the next box down is 25 lots and higher. The next is 50 lots and higher. And the bottom is 100 lots and higher. The S&P, all markets really have become more fragmented due to iceberg flow, and how to spot big traders in the market is not easy anymore. Typically, large traders are fragmenting via sophisticated execution tools. So ironically, it's easier to spot a 500 lot trader by looking at 25 lots than it is by looking at 500 lots. Also, there are multiple ways that the orders now, prints rather, hit the tape, depending on whether you're seeing the smallest unit of transparency. In 2009, the Merck changed, Globex, I should say, changed the tape to being the smallest unit of transparency. So if a 500 lot trader hit the bid in the market, instead of seeing a red 500 on the tape, you would see a whole bunch of red little numbers that the 500 crossed with based on time price priority rules. That is changing, and now both functionality is available, and depending on who your execution feed is, it's going to depend on what level of transparency that you're seeing. Again, topic for another time, but suffice to say that's what the stats are. All right, next topic. When we, not the market structure stuff, but when we drill down and look at price action in the market, as we call it, we want to see the rotations in the market, the actual rotations, pushes and pulls, as we call it. Whenever the market auctions anywhere, any level, it pushes up, and then eventually the buyers fail to the north, and then it pulls back, and then they see how many more new sellers want to come in, and basically then they get exhausted, and then it fails to the south, and then it rotates back up, and then it rotates back down, and regardless of how you're looking at that is what's happening, and anybody who's ever looked at a market or traded for any degree of time knows that that's the case. We have found that point and figure or reversal charts are the best way to see the rotations, because they allow you to identify a periodicity range for the strategy that you trade. Like, for example, if you're an intraday trader for any given market, there's a pretty narrow range of periodicities that you could set a point and figure chart to that show the rotations about as good as the next, because they're just pushes and pulls. So you should learn to be able to read it regardless of what you have it set to. This happens to be set to 6-tick reversal or point and figure, which is a good, between 6 and 8 for the S&P minis is about right. And people have different reasons for where they want to be on that. But the idea is you want to set it to something that allows you to most easily see these rotations, pushes and pulls, pushes and pulls. So the bar that has the red on it, that was a push up, right, into the yesterday's high, the 95s, and then fails to the north, and then it pulls back, and it actually pulled all the way back. It pulled up to the former 95 structure, which ended up being the Globex high, and then pulled back to yesterday's RTH high 92s there. So push, pull. Sometimes they're going to be shallower, sometimes not. When you see long bars, when you have a point figure chart up, it typically means that, well, not typically, it does mean that the market is having difficulty pulling back. So when you see single long bars and point figure, like you see here with the red, you're seeing this big push up here. not, having strong momentum in the market. You'll also typically see thinner volume when you see that happen as well. On one side, like you see here on the bid side, because the market's, moving up with momentum. And then when the market is grinding and moving sideways, you tend to see shallower rotations like you see here on the left before we get to the red bar. So that's what you need to know about price action. Sorry if I sound like I'm rushing, but I want to make sure I have enough time because I know that most people want to get to the order flow stuff, which is probably the most interesting for many of you. So rotations in the market. Remember, so at this point, here we are. We've for example, and this is just an example of a potentially viable way that somebody might use point and figure in this case and order flow, which is the third component to identify a trade opportunity. So you've identified that the 95, right? Let's go back here and look where that came from. Right, here's that 95, which was yesterday was what? Wednesday. So Tuesday's high was 95, and you could see that this was a major resistance line here. So you would have planned in advance. In this case, this happened before the market opened, the cash market opened. It's just for illustration. You may not trade then, other people may. I'm not making a case for or against it. I'm just saying I got to draw some pictures here and show you. Okay, so 95s you've identified as an area that you're interested in. You're waiting for the 95s. You see what happens when we get to the 95s. So now we get to the order flow stuff. We push up into the 95s, and you say to yourself, well, by my particular strategy variant, I'm a bear. I don't think this bull is going to hold, and I want to sell the 95s ahead of the open because I think we're good for at least another rotation. We already had a big run up in Globex. I think it's due for a pullback. Whatever your reasons are, you got your eyes on the 95, and when it gets there, you're going to decide what you want to do. Okay, so I highlighted the area in yellow to show you to sort of differentiate between in general using, which is how we advocate reading the prints, the density of prints as we call it, a lot or a little, as I will say. We advocate using a zoomed out view. People get very, very overwhelmed with these charts because there are a tremendous amount of numbers on it, and it's all very confusing. And I have said many times, and I continue to say, that I believe that if you are an intraday swinger, meaning you're not a scalper, you don't scalp ticks, you're not a market maker, in which case you would probably most definitely be interested in the order book, resting orders in the book, whether they're firming up, whether they're being pulled or stacked, whatever, because that is information that is relevant to scalpers. Again, if you believe what we believe in terms of the deck is constantly being reshuffled, my broken record speech about that what the market's doing an hour from now isn't going to have anything to do with what's going on in the order book right now. All that is sort of information for you to go, here's what's happening right now. But and you could sort of carry that on to the prints as well. Prints, you know where people got in or what they did. That's all you know. You take a shot and you see what happens, okay? So for that reason, I advocate that if you're an intraday swinger, as we call it, you want to sell 95s and scale some at 92s, a few handles at a time, like most of you are. We, to this day, continue to use still charts in our educational examples. And we've had some people question that, and I think I've made it pretty clear why we choose to do that, because it eliminates the confusion. If you think you're going to watch these prints real time and make those decisions, you're probably going to miss the big picture because you're going to get sucked into the minutia of the auction as it's happening. And like I said, if you're a scalper, you need to do that, and it's just going to be very important to your results, obviously. But if you're a swinger, you need to put together a string of trades over a week's, month's time where you say, you know, this is what I like. This is what's proven to me through my manual back testing, as we call it, with the risk overlay that I want to use to be effective over groups of, you know, a month's worth of trades or more. And I feel pretty good about it. And I need to get in there and identify these broad conditions and execute. So, you know, we advocate letting a range of order flow build enough to where it jumps off the page. I mean, you're looking at the right edge of the chart, but just to the left, you know, of where the new, that's what's great about the rotational, is that you're not getting a new bar whether you like it or not. You're only getting a new bar, in this case, if the market has rotated 6 ticks off the high. Then you go, okay, wow, we've rotated 6 ticks off the high. What just happened right there? You zoom in, you look at what's going on in that, across that range of prices, and if it meets your criteria, you're good. Is it going to let you sell the edge tick? No, of course not. But I mean, you know, let's be realistic here. And even if you could, what's the value of that anyway? Because of the ever unfolding, you know, you don't know what's going to happen next, right? So anyway, so the big picture, the zoom out that we like to say is, how do you know if it's a lot or a little, and what does a lot or a little mean in context, right? And we're talking about the total number of prints per price, right? So depending on the time of day, 2,100 lots or 20, you know, I should zoom this. Huh. Not that. How's that? Can you guys see that better? Is that better? Okay. So how do you know if it's a lot or a little? You zoom, you know, if you're appropriately zoomed out, it's going to change depending on what time of day was. This occurred, what you're looking at in red and in yellow anyway, occurred before the cash open. So obviously the S&P is not as thick before the cash open, so that the relative numbers that you typically see at a price are smaller. So as you look at the red box there, look left. Look at, you know, recent order flow activity, whatever. You know, I'm not going to give you how many bars or whatever. It's relative. I'm trying to, you know, get you to think in these kind of terms instead of getting wrapped up in the minutia. Look left, and what you see is that typical volume per price on either side is not 2,400, you know, 2,000 contracts. That's a lot. That's evidence that something is going on, right? And that is part A, right, of what's going on the lot side rather than the little side. So what happened in red was the market was well aware of the 95 structure, as you remember from that longer term chart, right? Why wouldn't they be? Everybody knew the 95 was a key area, right? And they had formulated decision making based on the 95s, just as we would expect them to. Who's going to end up being right and for how long? Who the knows, right? We don't know, because that's all relative to the risk overlay. But what we did see is we saw a lot of passive sellers step up against the aggressive buyers, right? Remember, aggressive buyers are hitting the offer. Well, if they're able to hit the offer and not a lot of passive sellers are willing to step up and take the other side, what happens? The market can easily move to the next price up, right? And that's what you see in yellow. The market had strong momentum there. You know, the buyers kept hitting the offer side, rallying the market, and up until we got to the red area, the passive sellers were not willing to step in front of it. I'll tell you a major reason for this particular range of price action was market makers knew that the 95 was a very important area and were actually pulling offers in front of it because they had book priority to try to get it to goose over the line and execute the very predictable stops that everybody would have. Guess what? 2 ticks, 4 ticks, a point or so behind the 95s, where everybody puts their stops, right? So, you know, the market comes up strong momentum. Market makers don't step up right in front of the 95s. And in fact, they're yanking, which allows the market to goose over the line and then start executing the stops that are behind it. And then, you know, the battle ensues, and then, you know, and on it goes, this thing of ours, as I call it, La Stoppa Nostra, right? So that's what's going on in red. passive sellers absorbing and then initiating short with their own aggression, and then the market rotates back down. The flow exhausts, there's nothing left, all the boards that's coming aboard, and we rotate back down, right? So putting it together, oh, one other thing, if we go down to the stats, you see that in that rally, the gray here at the bottom is this is delta, divided by size, which means how aggressive, and you could see by the density of the color how aggressive they were. That's pretty dark gray there. So, a lot of relative aggression hitting the offer to drive that market up into the 95s. And then these are just volume metrics, which we'll leave out for now for time purposes. And then the top line divided by size is something we call delta finish, which is the net change in delta off of the last high or last low. So what happens is as they exhaust, then we start to see that the delta was really long into the highest high, but then it started to peel off the net delta because not as many people were long because they're getting out, and then that creates delta finish, which shows you that there was selling off of the highs, right? So that's what you're seeing there in the stats, okay? So we come up to this area. Maybe it's a way that you initiate short because you're a short swinger. You notice, wow, that's a lot of volume. You know that what I just said is what happened because it's the only thing that can create what happened. There's only, there's no, these are not my opinions. This is what happens, okay? It's whether it's good for you to execute on it depends on the specifics of your model. But that's what's happening, and that's why the market exhausted there, and based on that structure. And then as of the bottom of the red box, it could have immediately rolled over and ran over the top of that red box and continued to rally right then. But it didn't, because as of the bottom of the red box, as you'll see, we didn't really see anything remarkable. The market traded down. We didn't really see buyers step up in front of it to a large degree with big volume. I guess they tried a little bit there right at the opening of that bar. They weren't successful, and then we immediately retraced. So what I'm showing you in green is that very predictably that was the yesterday's high 92s, where that orange line is. And very predictably, we start to see the print count actually swelling up just a little bit in front of that. Why? Because people who were short from above were getting out. How do shorts get out? They lift offers when they see the first sign of trouble. That creates that. Market makers, again, know the market's due for a bounce, so they step in front of it to try to catch a rotation. And what you'll see interestingly in the stats down here in green, notice this. Remember, delta's on the bottom. This is the net delta of the little guys, small traders. Net delta of 25 lots, also red into that push down. Ooh, but look here. The 50 lot traders and the 100 lot traders were net buyers into that push down, right, proactively. So that not everybody uses those stats. They're not a magic bullet, I'll tell you that. But that's another way that people subdivide these rotations and the order flow and the whole big picture into saying, when we have a move down into an area, I only buy if I see size leading out long, for example, as we would call it. Again, there's too many other moving parts, but that's an example of how you know what traders are doing across different size coming in, using the point and figure format. Okay, so and back to the big picture, if you had a strategy where you were looking to sell the 95s, most of the DTG members trade structure to structure, as we would call it. In other words, they're waiting to get in, whether it be long or short, and they don't necessarily have to be counter trend traders fading. I'm going to show you a continuation example next. They can be, they don't necessarily have to use any of the components, but if they're trading structure to structure, they're saying when we get to the 95s, in this case by my model, I'm looking to short, and then once they get in, they have their eye on the 92s. That's the next structure below. That's what we call a previous resistance turn support, or R to S. So when we get back down to the 92s, if they're using an order flow component and price action component, they'll wait for it to reject, to the downside somewhere in the 92s and see evidence that buyers are coming in and the market's starting to rotate up. And if so, then they scale at the 92s. If they're holding for a second scale, I believe the next structure below that was the 87s maybe, which was the Globex low last night. And then that might be their next area. And then if and when we got to the 87s, which we didn't, they would go for a second scale. And if it didn't get to the 87s and rotated back to their entries, they might scale the second half at break even plus a tick to cover costs. Whatever, maybe around this area right here would be a way, where they would have a rule in their model to get out. Can you guys see where my mouse is? Right on the next bar after the green, up near the top, you see 5,000 trading on the offer and the bid there. If they didn't scale, and in other words, they got in at the 95s, they're looking for the first scale at 92 next structure. Do they see a reaction? Yes, they scaled. Now they still got half their position on, hoping that we continue to retrace to the 87s if that's what they were thinking might happen. But we didn't get to the 87s, so if it came back and threatened their entry and they saw big volume building, a big fight, they don't want any part of it. They use that liquidity to scale out in. And so that might be where they scaled their second half, because obviously it didn't feel like continuing to the downside. Okay, makes sense? All right. So let me zoom. Well, before I zoom, let me show you this. So this is also from today. This would be an example of how our members typically use the same information of price action and order flow to trade what we call continuation trades, which means that rather than fading an area, they believe that the current directional side that's in control, whether it be bulls or bears, are going to continue. And where they get that information may come from correlative markets. May come from news. Just general sentiment, whatever. Again, beyond the scope of this discussion, this is what we beat up day in and day out in our community as people figure out what components that they want to use in their models and get feedback on integrating them and how various risk and reward overlays adaptable to volatility and so on might work with them. That's what DTG is a dojo for developing strategy and risk models which lean on that, this trifecta, so to speak, that's in the methodology white paper in various forms. So if somebody had continuation trading as part of what they did, this would be an example of something that's pretty interesting that we could see in the flow here. Okay, so this was where we tested the 99s. You guys will remember from here. There's the big 99.5 there that everybody had their eye on. So what do you know going in? If you're looking for the 99s, you're looking to trade at the 99s, you're going to know a couple things right off the bat. You're going to know there's a bucket load of stops behind the 99s. You're going to know that it's going to be a real shit fight there. Market makers are going to try to make their ticks. Everybody's going to try to trap the trap, and the trap's going to trap the trapper, and it's going to be a madhouse, right? Because it's such a major level, right? That's what you know going in. And when we got there, suffice it to say that we saw a lot of action. How do you know it's a lot of action? Back to what I just said, look left. I don't want to zoom out again, but suffice it to say that if you look left from here, you don't see 6,000 and 7,000 printing on either side like you do in that box in purple. It's a lot. Okay, what do we know about a lot? We know that a lot is indicative of whatever the non-dominant side is stepping in front of the dominant side to slow it down. That's why it can't continue. It struggles through there. Aggressive buyers hitting the offer, and they can't break it through because the other side passively is stepping up. All that flow, it's either already in the book. And a note on that, there's so much iceberg flow. The idea that you can use these tools these days that have, show you how many resting orders are in the book, certainly it's something that you want to know, but whether it sticks or not is going to be decided at the last second. So you need to be aware of that. But I'm sure that anybody who was looking at the order book at this time saw a lot of resting orders in the book. I would be very surprised if they didn't. Obviously, as many resting orders are as there were in the book stepping up to sell, well, we see how successful they were. Not very, right? So that's you got to keep in perspective the validity of resting book order information. It just tells you what's going on in the book right now, not what it's going to do. The prints always tell you what was done, and that can be used against them, so to speak, because that's not nebulous. We know that for sure, right? So, all right. So guys step up in front of the buyers here, but they really could only slow them down temporarily. Market makers probably scalp short and long for a tick here because they expected that wobble and flow, predictably, kind of a layup for those strategies, as I would call it. But notice how we spilled, as we call it, quite a bit beyond. WB calls spills directional, uses it in a directional sense, just so you guys know, because I know that he uses that term too. We all have different funny terms that we use. For us, spill just means some sort of travel beyond a known case price for a structure. 99.50 was a case price. There might be a lot of activity in a zone, like you see in the red area here, that we would think would be kind of where ahead of time where the activity might be. And as you see, that is where it was, predictably. Spill is just how, a little travel beyond a structure, which is what we see here. So what I'm showing you there in yellow is the difference in, it just kind of, the buyers initially broke through, but eventually exhausted to the high side. The prints get thinner, and then we rotated back down, and 6 ticks off that high in yellow, we started the new bar. So this new bar here, if you count down from the high, 1, 2, 3, 4, 5, 6, this new bar actually formed where the 1606 is here, right? So you're watching this, you're seeing it, and obviously if you were a short and you decide, for whatever reason you were short and you were looking to sell the 99s, did you see the big spike in flow? Yes. Did that spike your trigger after the fact? Yes. Maybe, I don't know. I'm just saying, maybe you were a seller there, and if so, and you lost, well, get used to it. You're going to lose some trades because other things didn't work in your favor. If the order flow is your final trigger, well, that's what got you in. And but what would you not want to see if you were a short here? What you didn't want to see is we opened that new bar there where it says 1606 on the left on the bid. And then as we pulled back, we pulled right back into the 99.50, which was the key price that we just broke out of. But look what happens. The sellers get really aggressive again, hitting into that 99.50. Well, what comprises that flow? Some of that flow was longs who thought that they were breaking out and they got in, and now their entry is being challenged, so they're choosing to scratch. That would be one example of guaranteed somebody who's in that flow. But then you also have passive buyers that say, hey, we had a firm break above 99s. We're pulling back to the 99s. If I see it stall here and the flow confirms that for me, and we see a nice lift off the low into that pullback, I'm going to look to get long. And we definitely saw those people in the flow. The point is the density swelled again. You see those prints, you see the big battle happen. It firms up in there. Potentially that's an entry for continuation longs. And what I wanted to show you here in the stats is, once again, notice we see into that pullback there, the broad market were net sellers. They're in green. 25 lot, 50 lot, and 100 lot traders were all net buyers into that shallow pullback down. So even though the market was moving down, price was falling, These guys were proactively stepping in and being aggressive, hitting the offer, wanting to get in, even though the market was falling. I mean, frankly, that's being a smart trader. You know, you don't want to buy a rising market. You want to buy when the market's falling back into an area, try to get as close to the edge as you can, and vice versa, right? So, not surprising necessarily to see that. But what is interesting is that there is a divergence between smaller traders and large traders in that push, which is evidence of a fight. When there's a fight, somebody's going to lose. Whoever loses gets out, and when they get out, they drive the market in the favor of the guy who's winning. That's just an auction. You know, if you're a seller and you realize that your selling isn't doing anything, what do? You puke. When you puke and you're a seller, how do you get out? You hit the offer. When you hit the offer, that favors the guys who were already in before you puked, right? So that's just stuff that you like to see in the stats, right? So these guys got long. Now, the reason that I have question marks in the next sections here is that, like I told you before, typically guys that are DTG style traders are looking for structures, known structures to trade into. So a guy would typically, say he wanted to be long from those 99s. He wants to have something known. Okay, the threes or a prior former structure or whatever. Well, we didn't have that, right? We were trading into air, as I call it, going into we don't have any. We know that this is the trouble. Since we know all market participants like to look at the past to determine what to do, nobody has that ability. So what do they do instead? Well, they tend to use things like fib retracements, standard deviation, pivot points, things like that even more, because they have an absence of those other tools that they normally use, which is former price action. They don't have that. So I'm putting the question mark there because, since you don't have any structure to go to, maybe an example would be you just say, well, if I see a bunch of density, sellers stepping up in front of it again, I'll just get out then. That'll be my scale point. So maybe this first purple box, maybe the second purple box would be an example of saying, boy, I don't like the buyers are having trouble here, so I'm going to scale because there is no prior structure. And then finally, I want to illustrate another thing that you see a lot in the price action, which in the order flow rather, which is price action and order flow rather, that's very, very powerful, and that's the box in navy blue. If you are a bull or a bear, if opposite, which I'll show you next, that is really what you want to see in blue if you're already long, or even if you're considering that as a trigger to get long. Back to our a lot or a little thing again. Well, that's a little. Look left and see what typical average prints per price were, and you get a sense. Boy, 4,000, 3,000, 7,000, 6,000 is nothing aside. And now all of a sudden, what do you see? The market rotates off that second box in purple and tries to go back to the south again, but there's just nothing there. The print counts step away. I assure you that there was absolutely, David. I assure you that there was lots of passive market maker flow that would have loved to take the other side there. There always is, looking advantage to take advantage of short-term order flow and make markets. But what you saw there and the print counts being so low is indicative of that. Even though the passive buyers were there ready to suck up any sellers that wanted to come in the market, the sellers were not interested in hitting the bid. Exhaustion. Sellers don't want to be short. In this case, they're probably scared to shit because it's a strong rally and anything can spook them. And who knows what it was? You'll never know because it's too vast of a system. But this is a nice, easy way to see that, sellers just don't want to hit bids anymore. So this is like a really bullish thing. So when we call that hard rejection in our parlance, we have all sorts of crazy terminology, but hard rejection is in a rotation, up or down. You see thin relative prints because of a lack of interest from whoever's, obviously push and pull, price action using point figure is always alternating, and that's another big benefit of using point figure, because minute charts don't always show you this stuff as clearly. So we hard reject the lows, and then it's nothing to rotate off. And then if you compare and you look at the difference between the bid diagonally, look at the difference between the bid side and the offer side off the low. 24 lifts to 127, 495 lifts to 1047, 267 lifts to 1868. And that's the big burst off the lows, which you'll actually see here. You see how strong the buy side was in the market, and just total absence of sellers. You can see the zeros here across the board. So, all right, so we rotate up, and we get to, I think I got to zoom out for this. This price action here that occurred up here, I put the line there to illustrate what I said before. That 350 is, or 375 or whatever it is, that happens to be the daily R3 for today. We've just seen from experience that when we're trading into air, an absence of prior market structure, it's very interesting how well respected the floor pivots and fib retracements or extensions and things like that are. Because, like I said, there's nothing else to lean on. Pivots used to be really, really powerful years ago. It seemed like everybody was trading pivots, and then they sort of took a back seat because form follows function. Less people use them, they become less respected. But I think it's interesting how the respect spikes. So another question mark there in purple, the last purple box. There's a lot of density up there. Might be a scale point for you. If you're long, again, you don't have any structure, but in your case, when you don't have structure, you might say, if I don't have structure, I look at the pivots. Might be a rule that you had in your model. I don't know. We know guys that do. So the combination of the density, again, sellers stepping up in front of it, and it's at a pivot point, I'm scaling. Or maybe you're getting short there. That's your clue to get short, because we've from the Globex low to here is enough. We think the market's due for a rotation, and we're gonna rotate at least back down and retest the 99s or whatever before the end of the day. I'm not saying you would or we will or whatever. I'm just saying that might be a strategy and how you'd employ it. The last thing is this second push, as we call it here. Rotated back up in purple, pulled back down here, this bar, and then we rotated back up here in red. You see the angle between the twos. In price action terms, we call that a failure, a high failure. Buyers pushed up, made a new high, pulled back, attempted to push back up again, and then see in red, we see the same type of thinness in volume that we saw in blue before. That's evidence of buyer exhaustion this time. Not only are they exhausting print-wise and unable to hit the offers, they're not even doing it close to the current high. They're exhausting way before the current high. So the combination of those two, high failure and buyer exhaustion, is another example of how people might use order flow in their models to identify entry or exit points. One last thing in the stats, you see this time, when we pushed up in red, we see that our delta into this last push up was short across the board. It was short, not only were smaller traders, but also larger traders were all net sellers into that last push in red, which again, those stats might be one of your triggers for your final triggers to entry, to find entry or exit or scale or whatever in the market. So in sum, you're looking at groups of price action to identify density or lack of density in the order flow, specifically the prints, and then that is your way of segmenting the market into trade events. Back to the presentation yesterday, that's what everybody does, whether they realize it or not, is whether how much discretionary or systematic or whatever is really irrelevant to this conversation, because everybody has to decide how they're going to segment the market into trade events and how they're going to scale or exit those trade events. We're just, most of our members are working on the next level. This is the easy stuff. You know, you could chop up the market activity any way you want and get in, but your risk overlay, the interaction of your risk reward parameters over groups of trades, is ultimately what's going to determine your success or failure. And depending on what your rule sets are, what type of risk models are appropriate for that kind of analysis are going to not only change, but they're also probably going to change a little bit in the future, as will be volatility from various, conditions at various times. So you have to have a way to adapt. So that's the varsity shit, and that's what people who really have a pro mindset are working on. I know this stuff is all ooh and ah, and it looks so like, wow, look at that. Look at how it always seems to call the turn or whatever. It does, but that it just, for now, for the next couple ticks, and then the market has to decide how it wants to process that information, and and then the deck is reshuffled and it's back to zero again. So you just have to keep this all in perspective if you're going to be successful in this game, and obviously couple that with reasonable expectations, as we talked about yesterday, so that you're not thinking that you're failing if you don't win 3 out of 4 trades with linearity and make 10% a month with a 15% margin to equity. Which unfortunately is what a lot of retail traders are trying to do, because there's a lot of dirtbags out there that are showing curve fit models and systems that perform very well in recent market conditions. A lot of them don't even realize they're curve fitting, which makes them even more dangerous because they're too stupid to know the difference. But they're playing the guru card and people listen to them. And but the good news is, and I got to go because it's David's turn. You're in good hands. Danny's kind enough to host our little adjunct room to our forum here. I think the world of them. The crew around here are old school guys, and maybe we're biased because we're old too. but you're with guys who know what they're talking about, and there's the whole other component, which is what the MTS room is about, which is discretionary reading of what's going on in real time, and all that. That's valid too. Everybody can just focus on whatever they're going to focus on because it's too vast of a universe. Danny's thing is it's a real time market commentary, which is valid. What's going on, what's driving it, what's going on with the news, what's going on with the cash markets and those desks, et cetera. And that is, as important as anything else. But for most traders, you got to have a process too. You got to have a risk model that's applicable to that process. You got to have your expectations aligned correctly. And that's kind of what DTG does. So it's all good. And at least you'll never see anybody around here filling your head with sugar plums and dreams of grandeur and all that stuff, and just telling you how it really is, which is probably not what the picture's being painted elsewhere. And what it is good. It's just you got to, maybe sometimes people have to realign their expectations of what good really means versus what they think it is. So on that note, hopefully we've made some sense. We have a free area, if whatever you want to call it, the trial page, which has our sheets every day that we post this week, and our daily founder educational example that we put up, which has these order flow and price action concepts annotated in text form, and then which is also a format that all our members do. They journal and articulate what they did in the day and what they think they struggle with, they need help with, whatever. But anyway, that I'll post a link after I'm done here again, or NJ will, and that is the available to you guys to go and see more of this if you're interested in it. So on that note, David, you're up, brother. Have a good one, guys.